Hi, it's August 6th, 2022. My name is Jason Shapiro with CrowdedMarketReport.com. I thought today I would get into speaking a little bit about the concept of contrarian and what it means, at least to me, in terms of approaching the market from a risk-reward standpoint, and some of the benefits to that, and as well as some of the pitfalls to that. So I would say at a very most basic level, we can look at it like this. There's some large number of people who approach trading the markets that lose money. And I don't know. I don't have the exact figure, but it's like 95%, 98% of the people that trade lose money over time. And these are traders like kind of what I try to do, which is directional trading, various asset classes, long, short, and whatnot. I would say if you're a long only stock investor that only buys and holds stock, given that the market has gone up over time, you probably don't lose money. But what you end up doing is underperforming. The same amount of people, 95, 98%, end up underperforming the market by doing that. So while they might not have lost money, they lost money relative to the fact that they could have just put their money in an index fund and sat there and done better. So it's the same thing. They lose money. So at a very basic level, simply, if we could find those 95% of the people and do the opposite of everything that they do, then we would capture as a profit the money that they lose. And that's really the simplest way to look at it, right? On a more sort of fundamental financial theory basis, the way I like to look at it is the market is a discounting mechanism, which means that the current price of an asset discounts all the known information that we already know. Okay, so we're looking to get the odds in our favor by figuring out where have things been over discounted. And some people will make the claim that they look at price, and this is where I differ than other people on what contrarian is, right? And I remember an example very well a few years ago, 7-8 years ago, when Amazon stock really started to kind of go on a rocket ship, and it was hitting around the $700 or $800 level, and Amazon has since split, so I think these numbers are not as relevant, or you'd have to re-split it to figure it out, but it was around 700-800, and suddenly everybody I heard was talking about how Amazon had gone up too much, it was overvalued, it was ridiculous, and blah, blah, blah. And I'm like, I'm sorry, but if all of these people think that it's overvalued, then clearly they don't own it. So it's probably going to keep going up. And I mean, lo and behold, that stock went up to like 3,500 or something like that after it hit 700-800 and was overvalued and crazy and all that. So that's the difference to me, right? It's not price that tells you that something is over participated in or overdone. It's participation that does it. So it's not saying, gee, price has gone up too much, so this thing's a sell. It's, to me, everybody is long this thing, so this thing is a sell. Or on the opposite side, obviously, it's not that price has gone down so much it's a buy. It's everybody is short this thing, so therefore it's a buy. And that's what contrarian is to me. Contrarian participation, not price. And again, because if you're thinking of it from a discounting perspective, did the price discount it, or is the fact that everybody's already in discount it, right? And from a trading risk reward perspective, it's everybody's already in, and therefore it's over discounted, and the risk reward flips the other way. And on a very extreme level, which could never happen, but if you think about it from the terms of if every human being had every dollar that they had in one trade, then how could it possibly continue to go up? Because there's no more money to put in it. I don't care what the news is. I don't care what the fundamental news is. It can't go up. So that will never happen, but we try to look for on a relative basis when that happens. So how do we find these 95% of the people? right? How do we know that they're long or short? And clearly there's a few ways you could do it that are unrealistic. You could open up a brokerage house and get a whole bunch of clients, and you can watch what everybody's doing, and 95% of the people are or whatever, when they're all lined up the same way, you go the opposite way. You could do the Ken Griffin model, open up a hedge fund, buy order flow, so that you're seeing a vast majority of the order flow in the markets, and know what everybody's doing and go the opposite way. Those are probably, without a doubt, unrealistic ways for most people to do that, including me. So how do we find this? Well, there's a couple ways that I do it. First, is data, because data doesn't lie, right? And the data that I like to use primarily is the commitment to traders data, because here's data that tells you where people are positioned, right? It shows you, hey, speculators are positioned in this market by this much. And then you can start looking at it. Is that a lot relative to history? Is that a little relative to history? Because this is all just about increasing the odds. Yes, 95% of the people are going to lose money, but when 95% of the people are now on the same side of the trade, I think that increases them losing money on that individual trade, right? It certainly puts the risk reward in your favor. So the commitments to trader data is good for that. Again, is it perfect? 100% no. But with proper risk management and proper discipline, it can be very good data to indicate when to go the other way from the masses on a certain trade. Another way to get a feel for this, which is not data related and which I do a lot, is I listen and read what people are saying. And suddenly, if you pay attention to this, suddenly you'll see at times that everybody is agreeing with the same thing. And if everybody is agreeing with the same thing, they're talking their books. And if all their books are the same, then you can start thinking about contrarian. And that can then, because that's participation, right? And then you can mix that with the data, like the COT data, or even put call data, any kind of sentiment data you're looking at, and it's all sort of coming together. And then suddenly you can start thinking about going the other way. A good example of this now, or at least in the last couple months, is the stock market's bouncing. And the entire way up since June lows, everybody has talked about how we're going to see new lows. This is a bear market rally, and we're going to see new lows, and we're going to see new lows. And I don't doubt that we are. In fact, I agree with it, but I don't trade that because I agree with it. If they're all believing we're going to see new lows, okay? And the trader's commitment is showing that they're all short, which the trader's commitment data is saying that they're all short right now, and was at the bottom and continues to show that, because they are selling into the rally, because they do think that this is a bear market bounce and that the market's going to see new lows. So there's a perfect example of where you want to be long. I was long with the commitments data back in June and the sentiment, and now it hasn't really changed. The higher it goes at this point, the more they think it's going to see no lows, and the more they think it's a bear market rally, and the shorter they're getting in commitments to traders. So it's going to continue, I believe, to squeeze them up. And at some point, they will have to give in, right? It will either be because the price has gone too high and they have stops and they break through different technical levels or whatever it is, and they have to get out because they can't take the pain anymore, or there'll be some sort of fundamental change in the market, whatever that may be, right? In this case, it's most likely related to inflation, and inflation expectations will start to go down. They will start thinking that the Fed is not going to raise rates as aggressively, and they will get out. And the beautiful thing about the commitments data is when they do that, it will show up because they're getting out. The commitment data shows that they're getting out, and we will know that, okay, it's time to not be long anymore. And I can guarantee you at the same time that that's happening, all of a sudden the mantra on TV will start being, oh, well, now the economy looks good. Oh, well, now inflation's coming down. Oh, well, the whole thing, it will all line up, and we'll know that the odds have changed, and we'll be able to get out. And again, this is all about odds. There's no guarantees here. But again, you take that 95% of the people that lose money, You get the fact that all these people are agreeing. You get the fact that data is showing that they're all one-sided. The odds increase that you can go the other way, be contrarian, and make money. And I'd like to just speak to one more thing, which is this whole magazine cover thing that some people like to talk about sometimes. And there was a recent one that was really funny, clearly, which was wheat was on the cover of The Economist magazine. See if I can find the wheat chart somewhere here. Here's wheat. Oh, we don't care about that. But wheat was on the cover of The Economist right here, okay? Literally right here. And they were talking about how there's going to be a food shortage in the wheat thing because of Russia and this and that and the other thing. And wheat's down, what, a good 45% since it was on the cover. So, why does that happen? Is it because the guys that write are so stupid? And if you think about it, it's the same thing that we all go through, right? This guy or woman, whatever, wants to write an article on wheat. Okay, that's probably somewhere around here, right? They do their article, they do their research, the article's ready. Now the editor or whoever decides what article goes on the cover has to agree, and obviously that person is looking to sell magazines and they want something that's going to get people excited, right? And they right at the top, they print the article. And it's just like when we trade, right? You want to sell something. Well, you're not so sure. Now you wait. It starts going down. Oh, well, now you want to wait until it bounces. And it doesn't bounce, and it goes down more. And then all of a sudden you just can't take it anymore. You sell, and we all know what that ends up being, the low tick, right? This is the same thing. They want to print an article. They got to do the research. You got to do the work. They wait. Now it's become a very topical thing. You got to print it. You print it, there's the top. This is all why contrarian stuff works over time. And again, yes, contrarian, but risk management, have stops, right? Because you could have thought the same thing about wheat here, right? Well, get stopped, sell it here. You have to wait for market confirmation. These are things that I talk about in some of the other videos. But in general, that's my take on being contrarian, how you can use it to your advantage, the things that you have to be careful of, which is just doing price. And that's about it. I hope you enjoy. Let me know if you have any questions or comments or whatever, and we'll see you again next week. Thanks.